The day you retire, you will do something almost everyone does. You will pick up your phone. Maybe you post on Facebook. Maybe you text your closest friends. Maybe you call your sister. You want to say it out loud because saying it out loud makes it real. I'm done. I'm finally done. And for about 48 hours, that feels incredible. I get it. I've watched people walk out of that last day like they've been holding their breath for 30 years and they just finally exhaled. But here is what almost nobody tells you about those 48 hours. That announcement, that moment of celebration, is the first financial mistake of your retirement. Not because it is wrong to feel joy, but because you just started a clock. Once the world knows you are retired, your calendar fills up. Your phone starts ringing differently. People who haven't called in years suddenly have plans for your Tuesday mornings. Family obligations resurface, social commitments multiply, and quietly, invisibly, the 12 to 24 months that are the most valuable window you will ever have to restructure your finances in silence. That window starts to close. There is a specific set of financial rules that changed completely in 2026. Rules around healthcare credits, tax brackets, and inherited accounts. Rules that punish people who carry a working year's mindset into retirement, even smart people, even people who planned carefully. If you do not update these 10 things before you tell anyone you have retired, you could lose tens of thousands of dollars to systems that were never designed with your interests in mind. This is what they are. Most people think about retirement as a finish line. You spent 30 years accumulating, putting money into your 401k, watching it grow, not touching it. The system was almost automatic. Your employer withheld, the account compounded, and you mostly stayed out of the way. Now you are on the other side of that line, and the rules of the game just reversed. In accumulation, the tax system rewarded you for putting money away. In distribution, it taxes you for taking it out. That shift sounds obvious when you say it out loud, but most people do not feel it until they see their first tax bill in retirement, and by then, the damage is already done. Here is the part that catches even well-prepared couples off guard. TCJA, the Tax Cuts and Jobs Act that lowered individual tax brackets back in 2017, officially expired at the end of 2025. As of 2026, rates have reverted. That 22% bracket you may have been planning around, it is now 25%. The math you ran 2 years ago needs to be rerun today. But the bracket shift is not the most dangerous thing on this list. The most dangerous thing is what happens when one spouse dies. I have sat with a lot of widows and widowers over the past few years. The pain I hear most often is not about the money running out. It is a quieter kind of grief. The shock of realizing that after losing a partner, the IRS now treats them as a less valuable taxpayer. When a spouse passes, Social Security income for the household typically drops 30% to 50%. The smaller of the two benefits disappears. But the surviving spouse does not get to keep the married filing jointly tax brackets. They get pushed into single filer status, where the thresholds for every bracket are cut roughly in half. So income goes down, but the tax rate on what remains goes up. Required minimum distributions from the joint IRA or 401k still arrive on schedule. Social Security is still partially taxable. But now all of it is being processed through a much narrower tax funnel. That is not bad luck. That is a structural feature of the tax code that almost no one explains to couples while both partners are still alive and healthy. If you have not done Roth conversions yet, if you still have a large traditional IRA or 401k sitting untouched, you are not just holding an asset. You are holding a 15 to 20 year tax liability. that your surviving spouse will have to manage alone in a smaller bracket, with less income and more pressure. The standard advice from most financial planners right now is straightforward. Start converting. Move money from your traditional accounts into Roth now while you are in a lower bracket before the widow tax problem becomes real. That advice is correct. But in 2026, acting on it the wrong way triggers a completely different trap, one that can cost you more than the widow tax ever would. So you do what the books say. You retire at 62. You are not yet on Medicare. You are buying health insurance through the ACA marketplace. And because your income dropped significantly after leaving work, you qualify for subsidies, meaningful ones. We are talking about the difference between paying $2,000 a year for coverage versus $17,000 a year. And then your advisor, doing exactly the right thing by every standard playbook, recommends a Roth conversion. Convert $30,000 from your 401k into a Roth IRA this year. Lock in the low bracket. Protect your spouse from the widow tax. Smart, logical, textbook, you sign off on it, and then the healthcare subsidy disappears. All of it. Gone. Not reduced. Gone. Here's the mechanism behind that. The ACA calculates your eligibility for subsidies based on something called MAJ, Modified Adjusted Gross Income. It is not just your paycheck. It includes Roth conversions, capital gains, even some Social Security. It is a broader definition of income than most people expect. From 2021 through 2025, there was a temporary policy, part of the Inflation Reduction Act, that softened the edges of ACA subsidy eligibility. If you went over the income limit, you did not lose everything at once. There was a gradual phase out. That protection expired at the end of 2025. In 2026, the subsidy cliff is back. If your MAJ crosses 400% of the federal poverty level, roughly $83,000 for a couple this year, you lose 100% of your ACA subsidy. No partial credit, no cushion. $1 over the line and you owe the full premium. I will be honest with you. When this change came through, I had to make some calls I was not expecting to make. Clients who had Roth conversions already scheduled for early 2026. I was on the phone asking them to pause, to recalculate, to look at the full picture again. Because in financial planning, what was optimal last year can be the wrong move this year. The rules shifted and the timing mattered. Back to the 62-year-old. His base income, Social Security, and a small pension sits at around $53,000 for the year. He adds a $30,000 Roth conversion. His MAJI lands at $83,100. He is $100 over the cliff. His annual healthcare premium jumps from $2,000 to $17,000. He saved maybe $3,000 to $4,000 in taxes by doing the conversion. He lost $15,000 in subsidies to get there. That is the anti-optimization trap. You solve one problem so precisely that you blow up another category entirely. This is the trade-off nobody draws on a whiteboard. Tax optimization and healthcare subsidy preservation are pulling in opposite directions right now, and you can only stand in one place at a time. If you are between 60 and 65, not yet on Medicare, and sitting on a large traditional IRA or 401k, this is the most consequential financial decision in front of you. Not the market, not Social Security timing, this. The question is not whether to do Roth conversions. The question is how much, in which year, and in what order, so you get the subsidy and the tax protection instead of sacrificing one for the other. You can do both. But it requires knowing exactly where the cliff is and planning your income to stay just below it every single year until Medicare kicks in at 65. If you are not tracking your Ma-J in real time right now, you are flying without instruments. Let me ask you something. If you passed away tomorrow, who would get your 401k? Most people answer that question with confidence. They say their spouse or their children. Sometimes they mention a trust or reference a will they had drawn up a few years back. And most of the time, they are wrong. Not because they made a bad decision, because they made no decision, or made one 15 years ago and never revisited it. Here is how this actually works. Your 401k is a federally governed account. It operates under a law called ERISA, the Employee Retirement Income Security Act. And ERISA has one rule that overrides almost everything else in your estate plan. The beneficiary form wins, not your will, not your trust, not the conversation you had with your attorney last spring. The form on file with your plan administrator, whatever it says, whoever it names, that is who gets the money. Full stop. This creates a specific problem for anyone in a second marriage. A significant number of people in their late 50s and 60s are in blended families. They have children from a previous relationship. They love their current spouse. They also want to make sure their kids are protected. So they write a will. They name their children. They feel settled. What they do not realize is that under ERISA, you cannot redirect a 401k away from a current legal spouse without that spouse's written, notarized consent. It does not matter what the will says. If your spouse has not signed a spousal consent form, they are legally entitled to that account, and your children from a previous marriage may receive nothing from it. This is not a loophole. It is the law, and it was designed to protect spouses from being quietly disinherited. The problem is that most people in blended families do not know it applies to them until it is too late to act. A 15-minute conversation with your plan administrator could prevent 3 to 5 years of probate and family litigation. Not because the law is complicated, but because the form was never updated. Think about how many life events have happened since you last looked at that beneficiary designation. A divorce, a remarriage, children who are now adults, a spouse who passed, an estrangement. The account may have been opened in your 40s. The form may still reflect a life you no longer live. Your will cannot fix a stale beneficiary form. Your estate attorney cannot fix it after the fact. The only thing that fixes it is updating it before anything happens. This is true for your IRA as well, and for your life insurance. Each account, each policy, each plan has its own beneficiary designation that operates independently of your broader estate documents. The retirement assets you spent decades building do not automatically flow where you intend. They flow where the paperwork says. Spend 15 minutes this week pulling up every account and confirming the name on that form is still the right one. That is it. That is the whole task. It costs nothing. It requires no advisor, no attorney, no financial plan. Just a login and a few minutes of attention. The people who skip this step do not skip it because they do not care. They skip it because they assume it was handled. Most of the time, it was not. There is a version of retirement that almost everyone pictures before they get there. Quiet mornings, a slower pace, maybe some travel, but nothing excessive. You tell yourself you have never been a big spender. You know your number. You have a budget. You are not worried about the lifestyle inflation part, that is for other people. And then you retire, and you announce it, and your phone becomes a different object. A friend you have not seen in 4 years wants to do lunch on Wednesday. Your neighbor asks if you golf, because he golfs every Thursday now, and there is an open spot. Your grandkids need pickup 3 afternoons a week. A local nonprofit you donated to last year now wants you on a committee, because you have time now, right? You did not budget for any of this. Not because you were careless, because none of it existed until the moment you went public. I have heard this from more people than I can count. The ones who describe themselves as homebodies, as low maintenance, as easy to please, they were the most surprised. Their social spending in year one of retirement was sometimes 2 or 3 times what it was in their last year of work. Not from extravagance, from availability. This is what researchers call the go-go years. The early phase of retirement, when health is good, energy is high, and the backlog of deferred living, the trips you postponed, the reunions you missed, the hobbies you always meant to start, comes due all at once. There is nothing wrong with the go-go years. The problem is using them as your financial baseline. If you project your retirement spending based on what you spend in year 1 or 2, you are building a 30-year financial plan on the most unrepresentative data point in your entire retirement. The sequence matters enormously here. Retirement accounts are not a static pile of money. They are a compounding engine, or they are supposed to be. If you are forced to sell investments in the early years to cover cash shortfalls from unplanned social spending, you are not just spending money. You are permanently removing shares from the portfolio before they have had the chance to grow. That damage does not recover. The math on sequence of returns risk is unforgiving, and it hits hardest in years 1 through 5. This is why a separate cash reserve, liquid, boring, parked outside your investment accounts, is not optional in early retirement. It is a buffer that lets your portfolio stay intact while your actual spending patterns stabilize into something real. 2 to 3 years of living expenses, not in the market, just available. Without that buffer, a single expensive year, one medical event, one home repair, one wave of social obligations you did not see coming, can force a decision that costs you far more than the original expense. So before you calculate your retirement income needs, wait. Do not use the first 3 months after your retirement party as your sample. That is not your life. That is the celebration of your life. The actual number comes later. Once the calendar quiets and the calls slow down and you can finally see what a normal Tuesday actually costs. That number is the one worth planning around. Most people treat Social Security like a fixed income stream. You filed, you got a number, and that number arrives every month. End of story. But the amount you receive is only half the equation. The other half is how much of it you actually keep. And that depends on a calculation most people have never heard of called provisional income. Here is how it works. The IRS does not tax your Social Security in isolation. It combines your adjusted gross income, your tax-exempt interest, and half of your Social Security benefit into a single figure. If that combined number, your provisional income, crosses certain thresholds, up to 85% of your Social Security becomes taxable. Those thresholds have not been indexed to inflation since 1983. They have not moved, which means every year, as incomes rise, more retirees quietly cross the line and hand back a portion of the benefit they spent decades earning. If you are doing Roth conversions, which we talked about earlier, those conversions count toward provisional income. If you are taking required minimum distributions, those count too. Every dollar you pull out of a pre-tax account does not just affect your income tax. It can trigger taxation on a benefit that many people assumed was mostly tax-free. This is why the order in which you draw from your accounts matters as much as the amount. Now set the tax question aside for a moment. Fidelity estimates that a couple retiring at 65 in 2026 will need more than $315,000 out of pocket. After Medicare, after insurance, just to cover basic healthcare costs for the rest of their lives. That figure does not include long-term care. It does not include a memory care facility. in home nursing, or assisted living. It is just the routine cost of staying healthy and managing chronic conditions over a 20 to 30-year retirement. Most people are not holding $315,000 in a dedicated healthcare account. Most people are counting on the same portfolio to cover travel, housing, groceries, and a medical system that gets more expensive every year. This is where insurance coverage deserves a real audit, not to buy more of it, but to make sure you have the right kind. If you are still carrying a large life insurance policy into retirement, it is worth asking what that policy is actually protecting. If your mortgage is paid, your children are grown, and your spouse has adequate income from retirement accounts and Social Security, you may be paying for a product designed for a life stage you have already left. That premium freed up could fund an umbrella liability policy, which covers you against lawsuits in ways your home and auto insurance do not. Or it could go toward a long-term care policy, which protects the portfolio if one spouse needs extended care and the other needs to keep living on what remains. The average nursing home stay runs over $100,000 a year in most parts of the country. One spouse needing 3 to 4 years of memory care can quietly consume a retirement that two people spent a lifetime building. Receiving Social Security at the wrong age does not just reduce your monthly check. It compresses your provisional income headroom, increases the percentage of your benefit that gets taxed, and makes every other financial decision around it harder to manage. The timing question in when to file is not just about getting more money per month. It is about how that decision interacts with your taxes, your healthcare costs, and the survivorship math we talked about earlier. All of it connects. So how do you actually live on something while keeping your May below the cliff? This is the part most financial content skips. It is easy to say, manage your income. It is harder to explain where the money comes from when you are not drawing from your IRA and you are not yet on Social Security. The answer is sequencing. You build a bridge. The first source is your taxable brokerage account. If you have investments held outside of a retirement account, a regular brokerage account, not an IRA or 401k, selling long-term positions can generate capital gains that are taxed at 0% if your income stays below certain thresholds. For a married couple in 2026, that threshold sits around $94,000 in taxable income. Below that line, you can harvest gains and fund your living expenses without adding significantly to your mashai. The second source is cash. If you entered retirement with a dedicated cash reserve, which we covered in the last section, this is exactly what it is for. Spending cash generates no taxable income. It does not touch your mashai. It buys you time. The third source is your HSA if you have one. Health savings account distributions used for qualified medical expenses are tax-free. They do not count toward mashai. For a household with ongoing healthcare costs, a well-funded HSA can quietly absorb thousands of dollars in annual expenses without disturbing your subsidy eligibility at all. What you are avoiding during this bridge period is any unnecessary draw from your traditional IRA or 401k. Every dollar you pull from those accounts shows up as ordinary income. It counts toward your mashai. It moves you closer to the cliff. The goal is to keep your reported income in the range that qualifies you for ACA subsidies, and to do that every year from retirement until Medicare begins at 65. That window might be 2 years. It might be 5. But during that window, your pre-tax accounts sit untouched, continuing to compound while you live on sources that do not trigger the system. This is not a loophole. It is a legal and straightforward use of accounts you already own, sequenced in the right order. The window matters because it closes at 65. Once Medicare begins, the ACA subsidy question goes away entirely. At that point, Roth conversions become the priority again. Converting as much as possible in the years before required minimum distributions begin at 73, while you still control the size and timing of your taxable income. Retirement is not one financial problem. It is 4 or 5 problems running simultaneously, each with its own timing, its own thresholds, and its own consequences for the others. The people who navigate it well are not the ones with the most money. They are the ones who understand which lever to pull, in which year, in which order. There is a reason this video started with that image of someone picking up their phone. Not to make you feel bad about it, but to show you how fast the clock starts moving the moment you go public. The 12 to 24 months before anyone knows you have retired are the most valuable months you will have. Not for celebrating, for restructuring, for locking in your MAS strategy before the subsidy cliff takes a bite, for updating every beneficiary form before a legal default decides for you, for watching your actual spending before a single go-go year number becomes a 30-year projection. None of that requires a big announcement. So before you post, before you text, before you call, do 3 things first. Lock in your MAGI plan for healthcare. Know your number. Know where the cliff is. Know which accounts you are drawing from and in what order, so that $100 of careless income does not cost you $15,000 in subsidies. Clean up your beneficiary designations. Every account, every policy. 15 minutes per account. Do not assume the paperwork reflects your life. Confirm it. Run your real spending number. Not the retirement party version, not the first 3 months. Wait until the calendar quiets and the calls slow down. Then build your plan around what remains. The silence is not a delay. It is the strategy. Retirement is not the finish line. It is the opening move of a financial game that is more complex than anything you managed while you were working. Because now the rules are different. The safety nets are thinner. And every decision you make interacts with 3 others you did not expect. The people who navigate it well are not the ones who celebrated loudest on day 1. They are the ones who stayed quiet long enough to see the board clearly. If this video helped you see a corner of that board you had not looked at before, subscribe to Wes Investor. There is more where this came from. I will see you in the next one.